About 6 years ago, after 4 hours straight of looking at charts, my eyes were essentially bleeding, and I was on my third cup of coffee. I managed to make what most traders would consider the discovery of a lifetime. I found a combination of a specific indicator technique and a bit of price action that provided a massive money-making edge in every market that I tested and traded it on. And this is actually still one of my favorite and most accurate ways of trading. It's exactly what caused me to get into the trade you see on the screen that we are currently in on the euro dollar. And the reason I still trade this strategy to this day is because it consistently puts me in positions that help me to make massive profits. And since that is one of the first steps of you becoming a profitable trader, is finding a consistent way to make profits, I thought it'd be a good idea to share this strategy with you today. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you are new. Click the notification bell, and I will see you on the other side of the intro and disclaimer. Welcome back, and first off, I'm going to be teaching you this entire strategy. So this strategy is something that I call ARDE, A-R-D-E. And no, it's not because I had a childhood friend named Artie, it's because it stands for Aggressive Reversal Divergence Entry. And that is a mouthful, which is the reason I call this strategy ARDE. ARDE is meant to help us take advantage of reversing markets. So markets that have been in a downtrend, but have a very high likelihood of reversing, heading higher and making massive profits. Now, if you've been around the channel for a while, you know that anytime I create or use a strategy, it must fall under this acronym, CEST, which stands for Conditions, Entries, Stops, and Targets. ARDE is no different. We have conditions that must be met before we have a reason for entry, which is the reason we actually hit the buy or sell button. We must have rules for our stop loss and for our target. So with that being the case, let's dive into all of these rules right now, starting with conditions. So before we dive into the conditions for ARDE, you will need to put an indicator on your chart. That indicator is the relative strength index. Go up to your indicators tab, type in relative strength index. It'll be the top one under technicals. Click that. It should be plotted on your chart. For the settings on this indicator, I delete the RSI based MA because it's not something that I use in the style of the indicator. Then go to inputs and I change it from 14 to 10 for this specific way of trading. Now, that should be the only indicator you need on the chart other than price itself. So let's go ahead and dive into the first condition of ARDE. The first condition of ARDE is that price must be making new lower lows. If we see price making these new lower lows, the second thing we're going to do is look down at our RSI indicator and ensure that at some point the RSI has went below 30, which is considered oversold on the RSI. The next thing we want to see is while price is creating these consistent lower lows, the RSI creates something called divergence. Divergence is simply when the indicator or oscillator you are using is doing the opposite of what price is doing. So when price goes from a low to a lower low and the RSI indicator goes from a low to a higher low, we have something called divergence. Now, as a very meticulous rule that is extremely important, on our divergence, we want to see that in our divergence, the second point has come in above 30, meaning coming out of oversold. To give you an example of what it would look like if that was not the case, if we had divergence and it did this, both of these are below 30, both in oversold. Therefore, this would not be where we look for an entry. You'll know more about that a little later on when we go through examples. Just keep that in mind for now. So in terms of conditions, we are all set. Our conditions for a bullish trade, bull, is that we need price to be making these lower lows. We need the RSI indicator to go oversold at some point. We need to have divergence in the RSI indicator based around price, meaning price making lower lows, the RSI making a higher low, and the higher low of the RSI indicator must go above 30 or above oversold. Those are our conditions. In CEST, what comes after our conditions? If those are all the conditions we need to see met, the next step in trading in general is to have a reason for entry. Now, you want this reason for entry to be as objective as possible, which is the reason I like to use the close of candles, market orders, and candlestick patterns for entries. So with this specific strategy, once all these conditions we just discussed are met, the next thing I'm looking for is the entry, and the entry is going to be based on one of two candlestick patterns. The first one being the engulfing pattern. An engulfing pattern is just when, for a bullish example, the green candle body is bigger than the red candle body. Here's an example of that. For an engulfing candle in the bullish direction, the engulfing pattern itself must come right after a red candle. This could not be a green candle. But the second type of entry that we're going to be looking for is something called a close above entry. This is when the candle that we're entering on closes above the high of the previous candle. Now, in this case, we can have a color change, meaning going from red to green, or the previous candle, that's the swing low, can be green. In both these cases, we're looking for the swing low that created the divergence to be followed by either a close above candle or an engulfing candle if this candle is in fact red. So now we have the conditions and the entry reason met. The next thing we're going to do is talk about stops and targets. Now that we have this entry reason met, as I said, the close of the candle with a market order is how I normally enter on trades like this. So I would be doing something like this, have my trade open. My stop loss would go below the swing low by a few pips. For the example we're going to do today, we're going to go 10 pips. So let's say 10 pips below. I'm not going to make that exact, just use your imagination. And for a target, I like to go with at least a 1.4 to 1. And that doesn't mean I'm going to take my target off right at a 1.4 to 1. This is something we're going to use for today's example. But a lot of times what I do is once price hits that 1.4, I move my stop loss to break even, and I see if I can get at least a 2.5 out of it by following these swing lows and managing the position, which is a little more complicated and advanced than what we're going to go through in today's video. But initially, for this strategy and for this video, we're going to be using a 1.4 to 1 reward to risk based on our stop loss. So now we have conditions, entries, stops, and targets for this entire strategy called Artie. And the next thing we're going to do is take a look at a couple of live examples in the bullish and bearish direction. So let's head down some charts and do that now. Back here on the euro dollar, let's go ahead and take a look at how the rules for Artie are coming together on real charts. If you take a look at price, what's our first condition for Artie? We need to see price itself pushing lower. Is that happening here? Are we making new lower lows consistently? Yes, we are. So condition one is met. What's the second condition for Artie? We need to see that the RSI indicator goes oversold. Does that happen? Yes, it does. We go below 30 right here. What's the third condition for Artie? After seeing price make lower lows and after seeing the RSI go oversold, we need to see divergence on the RSI indicator. And what is divergence? Divergence is when the indicator or oscillator is doing the opposite of what price is doing. When price is making these lower lows and the RSI indicator is making these higher lows, then we have divergence. And the final condition for Artie is that our divergence must come out of oversold or be above 30. Is that rule met? Yes, it is. So we have all of our conditions met. After our conditions, the next step is to look for our entry reason. What's our entry reason? We're looking for either an engulfing or close above candle. Check it out on the chart with me. Now that we have all of our conditions met, check out what happens right after the swing low that created the divergence. We get a nice engulfing pattern. And that is the exact reason, with all those rules met, that I decided to enter this trade here on the euro dollar. I did place my stop loss differently on this trade. And the only reason is because this trade was in combination with a previous level of major structure as well. And I wanted to get below that major structure. There's always going to be a bit of discretion with any trading strategies that you have. But in this case, let's talk about how the trade is going so far. We pushed up to that 1.4 to 1 reward to risk ratio I was talking about. Then I decided to move my stop loss to break even. After doing so, price began to consolidate and create this little support level right here. What I did next is move my stop loss to right below that support level. Let me explain why. The reason I decided to do that, if you look where price is right now, if price keeps going lower, breaking below the previous lows, that is a really good indication that we're just going to see a continuation down here on the euro dollar. But if we don't do that and instead we break out of this period of consolidation to the upside, then I have a pretty good chance of hitting my targets that are right here around 1.0347. So that was a little explanation around targets, stops, and how I manage my position while trading Artie. And that was a look at a bullish version of the strategy on actual price charts. Let's take a look at a bearish version of this on price charts so I can explain those rules to you as well. So to break this down simply and quickly, with a bearish version of this strategy, we're looking for the exact opposite of a bullish version. We want to see price making higher highs. We want to see that followed by RSI going overbought instead of oversold. We want to see divergence, meaning the RSI indicator making lower highs while price is making higher highs. And we want that divergence to come out of the overbought area, which is above 70, going down below 70 for our divergence. Once that happens, we'll be looking for a bearish version of an engulfing or close below candle for entry. Now let's take a look at some charts and see if you can spot this pattern. Look at these charts right here and tell me, is this currently where we're at a RD pattern? Hopefully you said no. Let's explain why. We do have price creating highs and higher highs, followed by more higher highs. Do we have RSI going overbought at some point? Yes, we do. Do we have divergence, the RSI creating a new lower high while price creates this higher high? Yes, we do. But what is the problem with this specific trade? That meticulous rule I was talking about, right? That one where the divergence must be below 70, must be coming out of overbought. Because that doesn't happen here, our conditions are not met. And even though we get this nice engulfing and close below pattern, we do not place this trade. I say we. Keep in mind, every time I say that, I just mean I. This is not financial advice. But because of that, I do not place this trade. What do? I wait. I have to see higher highs in price, and I have to see an RSI divergence that is below our overbought line or below 70. Let's go ahead and see what happens if we click play. So now what do we have? Now we have price that has made a new higher high, right? This high is in fact higher than this high. Is the RSI indicator diverging? Yes, it is. Is the divergence below our 70 line? Yes, it is. Therefore, would this be a trade because of this engulfing candle? Hopefully you answered that with yes, because that in fact would be a valid bearish RD pattern. We have our stop loss. We'll go 10 pips this time. So we have 28 up to that high. We're going to go 38 on the stop loss. And we're going to go with a 1.4 to 1 reward to risk ratio at first. Let's see what happens. Whew, close to that stop loss. This is the euro dollar, which has outrageously small spreads, which means this likely would not have been stopped out depending on the time this was. Hopefully it wasn't 5 p.m., right? But with that being the case, let's click play. As you can see, price in fact pushed down to our targets. So that's a good bearish example. And let me point this out too. The reason for our RSI divergence needing to come below 70, like we did right here with this divergence and this candle, is because a lot of times throughout my testing and trading, I have noticed that if we have divergence, but the divergence stays above the overbought line, a lot of times we make new highs after that. Therefore, waiting for the divergence to come out of overbought is a better indication of that possible reversal. I can show you a really good example of this actually on the trade we took. So here on the euro dollar, the trade we're actually in, you can see that price was making new lower lows and that we were oversold that entire time. As you can see, we do have divergence. We have price creating lower lows. We've come out of, or not come out of, but we have been oversold for a while, but price just continued to fall until when? Price continued to fall until we got divergence, and the divergence came out of oversold or went above the 30 line on the RSI indicator. Before we take a look at a ton of examples and I tell you the next steps you should take in order to increase your odds of becoming profitable with RD, the trading strategy you're learning in this video, I do want to let you know that we have some space available right now in the TTC FX University. In it, you'll learn more rules-based strategies just like this one that I use on a daily basis. You'll also be receiving the Pro Trader Report and a weekly setups video that will show you the setups I'm looking to take the week ahead. That comes out every single Monday. You'll be receiving email analysis 3 to 5 times a week, which is trades I'm actually placing that are based on the strategies you're learning inside of the university. The university is a complete university style course, kind of like a glossary to take you from wherever you are to professional trading. And the most important part is that while you are involved in the university, you will have access to me directly to help guide you and mentor you along your path to becoming a professional trader. So if that sounds like something you're interested in, feel free to click the first link in the description or go to www.ttcfxuniversity.com. If not, that is completely fine too. I want to talk about the next steps you need to take to increase your odds of becoming profitable with the trading strategy you're learning right now. So most of the time, whenever a trader learns a strategy on YouTube, they go and just start trading that strategy randomly, and because of that, they end up losing a ton of money every time they learn a new strategy. And that is because they didn't take the proper steps. So now you've learned the rules of this strategy, and we're going to take a look at a ton of examples to ensure that those are engraved in your brain. We're going to take a look at examples through the process of backtesting. So I'm actually going to backtest some examples of this strategy with you on the pound dollar. This is your next step as well. When you learn a strategy like this that's completely rules-based, write out the rules. Oh, like this, on a little checklist. Write those rules out, put them right beside your desk, and then go through historic data, which we're going to do in just a second, and look for every time your rules for this strategy were met. Throughout historic data, write down those results and look at the statistics. It'll help you practice, it'll improve your confidence, and it will also give you the statistics you can expect out of said strategy. So with that being the case, let's take a look at some of these trades on the pound dollar and do some back testing together. Right now, we are going to take a look at a few more examples of the RD trading strategy, and also I'm going to be back testing it with you together. Now, in terms of back testing, one thing that you will need is a way of recording the data. The best way I have found to do this is with this spreadsheet that I created a long time ago. And because I'm a super nice person, I'm going to give it to you for free. The only thing you have to do is click the link in the description that says spreadsheet, or go to www.thetradingchannel.org/TTC spreadsheet. Once you do, you'll land on this page. Check out this short video that'll teach you everything you need to know about the spreadsheet, and go to click here for your free spreadsheet. Once you do, you'll need to enter your first name and your email address. Click yes, I want the spreadsheet, and it will download automatically and send you an email with the spreadsheet attached. Once you've done that, we can actually get started backtesting. So let's take a look at a few other examples while I backtest this with you so that you can have a better understanding of what backtesting really is. So here is our first example. This is a bullish RD pattern. Why is that the case? Well, we have price pushing lower. We have a low followed by a lower low on price. That should be pretty easy to see. At that point of the first low, we do in fact go oversold. An easy way to do that is just hover over where that candlestick is. And again, if you look right over here, once I hover over that, you'll see that this is below 30. That means oversold. So once I hover over it, look to your left, 29.85 is the number you see. That means we are in fact oversold when price has its first low. We then get that lower low, we get divergence on our RSI indicator, and our second low that's lower than the first low is in fact coming out of oversold and above the 30 line. That means we so far have the first two conditions as valid with lower lows, RSI divergence, three conditions, and RSI divergence coming out of oversold. Next up, we look for what? We look for one of our entries. CEST means that conditions are met. Now we want to see one of those entries, either engulfing or close above. We actually get both here with this engulfing close above candle right here. At that point, after E, we want to look for S and T, which is stops and targets. And this is where we're going to start plugging in these numbers to our spreadsheet. So for stops, we're going to go with 10 pips below. Right here, it's 113 pips down to our low. We got to add 10 pips to that, which is going to be 123. Now, for the sake of this video, we're going to go with a 1.4 to 1 reward to risk ratio. So now is when you would go ahead and plug this into your spreadsheet. Let me show you how to do that. First off, we're going to put the pair that we're trading, which is the pound dollar in this case. We're going to go ahead and put the time of this trade. If you look down here, the reason I use vertical lines like this green one you see on the screen is because if you look down, it actually puts the time and date in a really clear area to make it easy for you to transfer that data over to a spreadsheet. So in the time, you would just put 1. Then on your date, obviously you'd go 4/7/20. For your stop loss, what's our stop loss? We had a 124 pip stop. And on our target, since we're doing a 1.4 to 1, it was 174 pips. Since we're only trading with one position right now, we can leave position 2 completely blank. And you would essentially do this for all the trades that you see, but I'm going to go ahead and do a few other trades with you right now. This way you can get some more examples of this strategy to be sure it is engraved in your brain. So here on the chart, we have a bearish version of Artie. Let's talk about it. What do we have? Well, first off, we have higher highs in price, right? That's our first rule. We know that because here's a high, here's a higher high, here's a higher high. Now, why is this not a trade? We have our engulfing close below candle right here. Well, if we look at that divergence from overbought, yeah, we go overbought. We did that right here to this divergence, which is this high. What we notice is that it's still above the overbought line. Remember, we want to make sure that divergence comes in below overbought, which is exactly what happens right here. We have divergence with prices heading higher. We have divergence on the RSI with the RSI going lower, and we have the RSI below the 70 line. All of that coming together to equal conditions are met. Next up, we need that entry. Do we get an engulfing candle? We sure as heck do. So with that being the case, we're gonna take a short position tool, place it on the screen. We're gonna go with a stop loss of 10 pips above our swing high, up to the swing high. We have 46 pips. That means we're having a 56 pip stop loss and a 1.4 to 1 reward to risk ratio. What do we do next? We bring up our spreadsheet. Easy enough. Then we check out the time of this trade, which was 1300 or 1 p.m. We check out the date, which was 6/10/20. And we go ahead and plug in our numbers. Our stop loss was 56 pips and our target was 78 pips. Second trade down. Let's go ahead and move on to the next trade, which is pretty easy to spot. It is right here. With price pushing lower, we have a low, we have a lower low. Do we have divergence? We have RSI oversold as well. Then we do in fact get divergence. And if we look at this low, it's actually all the way over here. So does that divergence, because we're looking at the lowest low, by the way, when we're looking for divergence, we wouldn't go here. We would go from the low to the next lowest low. Then we would go from our low on the RSI that went oversold to that low. Is this low higher than this one? Yes. So we have divergence. Is it above 30? Yes. So we have that rule met with us having lower lows on price. And we do in fact get a close above candle. As I said, the previous candle can be green if we get that close above, meaning the close of this candle is higher than the high of the previous candle. After that, we're putting on our position tool, 10 pips and a 1.4 to 1 reward to risk ratio, which is in fact hit here on the pound dollar. Very small spreads. So even though this looks like it's only a couple of pips above our target, it would have in fact closed that position for profit. Let's go ahead and move on to take a look at our spreadsheet and plug these numbers in now. I'm just trying to give you guys a brief lesson here on backtesting. We have that candle is a 5 a.m. candle. It is on 6/15 of 2020. And what are our stops and targets? We had 98 pips. On our stop loss, we had 137 on our target. Let's move on. Let's take a look and do this for one more trade. Then we'll take a look at the overall results of this trading strategy from 2020 to today's date on the pound dollar. Here's our next trade. As you can see, we have prices pushing from one high to a slightly higher high. We have the RSI going overbought. We then have the RSI pushing down and creating divergence right here at this high. As you can see, we also have that divergence coming below this line, which is overbought, or below the 70 line here on the RSI. So that is our third rule, and we have all of our conditions met. Next up, we look for either engulfing or close below candle, and we get an engulfing candle. Putting a short position on, you can see that unfortunately, price just continued higher and stopped us out on this trade for 49 pips. Now, what's our next step? After that, we know that's 49 pips. We'll delete that. We just come to our spreadsheet and continuously do the same thing. That trade happened at 1 o'clock. That trade also happened on 7/24/2020. That trade also had a loss that I completely forgot. Let's go ahead and check that one more time. What was the loss of? 50 pips. So in this case, when you lose a trade, you will put your stop loss in the spreadsheet, and then you'll put a negative, whatever your stop loss was, on your position. So that's how that would look in the spreadsheet and how you would plug in the numbers. And that is a brief lesson on backtesting. Now let's take a look at the results throughout 2020, 2021, and 2022 using ARDI on the pound dollar. All right, so let's take a look at what the steps you need to take are for you to become a professional trader using this strategy. And these are the steps you need to take for any strategy that you learn or create on your own. Right before we do that though, check out the results of the ARDI, A-R-D-E strategy. Here on this spreadsheet, you can see the results over the past 2.5 years. It produced 19 trades, with 12 of those being wins, 7 being losses. That's a 63% win rate with that 1.4 to 1 reward to risk ratio, bringing us to a grand total gain of 20.92% with a max drawdown of around 6% for this strategy over the past 2 years. Now, 19 trades is not enough of a sample size to validate these specific results, but it is enough to continue taking a look and testing this strategy. And again, this is a strategy that I've used for years in order to take advantage of big reversals in price. So definitely worth taking a second look and testing, especially if you're a trader that trades on smaller time frames. It only produced 20 trades or so over 2-year span on the 4-hour chart. But if you trade down the hourly or even lower than that, then you're going to get a lot more trades than just 20 trades per pair. And remember, this is just on the pound dollar. So if you had like 5 or 6 currency pairs you use this with, then it would create a lot more trades, right? But let's go ahead and go to the blackboard and talk about your next steps. You've already learned the rules of the strategy. So step 1, anytime you are trying to become a profitable trader, is to learn a strategy, right? Or either create one on your own, which is what you just did. So that is like X'd off. You're good to go there. You just learned how to backtest properly using a spreadsheet. Remember, the link in the description is how you can get that spreadsheet for absolutely free. After doing this, you're going to start plugging in all of the information about the entry, stops, targets, the time and date of the trades, the pair you're trading on. And the reason we're doing this is, 1, so you can practice. You need to practice the strategy and train your reticular activating system to see this pattern really, really quickly. But also it's so we can take the next step, which is to optimize this trading strategy. You can optimize for a infinite number of things, right? But in this specific case, the main things I like to optimize for are stop and target placement, along with the different currency pairs that a specific strategy works best on. So you may want to look at like 10 different currency pairs or 20 different currency pairs, test all of them. And then after testing all of them, pick the top 5 to 10 that this strategy works best on. This is going to help you minimize that maximum drawdown so that you can trade in the safest way possible. And it'll also help you to only trade currency pairs that this strategy works on. You don't want to be trading any strategy on a currency pair that over the past 100 trades, it hasn't worked on, or it's produced a negative return. That's just going to add to your max drawdown and cause your trading to be less efficient. After optimizing, your next step is to create a risk management plan. See, after we optimize, we can get an idea of what the max drawdown of a strategy is likely to be. To give you an example of that, if we continue to backtest this and we looked at 100 trades, we would have the potential max drawdown. Now, this number is not set in stone. We can't predict exactly what's going to happen in the future with historical data, but it does give us an idea of what the average drawdown of this strategy will be. So after your optimized results are all plugged into your spreadsheet, you'll see this max drawdown number, and that's going to help you create a risk management plan that you can easily follow, that'll keep you from going really deep into your emotions. To give you an example of that, here we have 6%. Let's say we tested over 100 trades on the pound dollar and it was still at 6%. Well, if you're comfortable with that 6% drawdown, you wouldn't need to change anything, and you would know that you should be risking somewhere around 2% per trade, or that's what I would do. Again, this is not financial advice. Do whatever you want to, it's your money, right? But for me, if I'm comfortable with a 6% drawdown, then risking 2% per trade is what I'm going to do. Whereas maybe I'm uncomfortable with that. I need it to be a smaller max drawdown. All I'd have to do is change my risk per position. This sheet allows you to do that really quickly, so you can always see what your risk per position should be from a percentage basis in order to get a max drawdown that you're comfortable with. You may be someone that's like, yo, 6%, that's nothing. I'm cool with dealing with 20% or 10%. Let's say 10%. Well, in that case, you may want to look at using 4% per trade with your risk management plan, which is going to dramatically increase your total percent gain you can get over whatever span of time that is. And it's also going to increase your max drawdown. So those are the two things you do need to pay attention to while going through this optimizing process, or excuse me, going through this risk management creation process. Once you have your risk management plan created, the next step is to create a full trading plan. A full trading plan, all it really consists of is all the rules for your strategy, including stops and targets that you've optimized for, the currency pairs you're going to be trading on. Essentially, this is your whole plan of what you're going to do every single day when you get behind charts. It also has your risk management plan. It may say something like, I never risk more than 2% per trade. This is a very simplistic version, but this is essentially what a trading plan is. You also want to have the times you're going to be behind your computer. You won't be able to catch every trade, but what are the times you are actually behind your computer every single day executing this trading plan you've created? That needs to be in your trading plan as well. And because most traders stop at strategy and don't do any of the backtesting, optimizing, no risk management, they don't create a trading plan at all. This is the reason you see traders switching strategies so much. This is the reason, if you're someone doing this, that you're having a lot of trouble handling your emotions whenever a certain strategy goes through a drawdown. The reason we do this backtesting is because over the past blank amount of trades, right? We can see that we had 3 losses in a row right here on the pound dollar. Well, if we were trading, let's say 5 or 6 currency pairs, this 3 losses in a row might be like 7 losses in a row. And so what if you started trading the strategy and it had 7 losses in a row? And although it showed a positive expectancy and it showed a max drawdown that you were comfortable with over a large sample size of trades, what if you started this strategy and you lost 7 in a row? Well, if you had done all the other work, if you had already backtested and you knew that that was a very average amount of losses in a row for this strategy, then you would be fine with that 7 losses in a row. You'd have the confidence to make it through that drawdown. But if you'd never done any of that work in terms of backtesting, if you had a risk management plan that almost blew your account because of 7 losses in a row, because you never did the backtesting, so you didn't know that that was normal, then you wouldn't keep trading the strategy, right? But if you put in the work to do the backtesting to gain confidence, to create a risk management plan that keeps you out of your emotions during losing streaks, and to create that full trading plan that you diligently follow on a daily basis, then your chances of becoming profitable and a professional trader go up dramatically. And if you skip those steps, your chances of losing either some or all of your initial investment are nearly 100%. It's going to be nearly impossible for you to become profitable, even with a profitable strategy, unless you take those steps. So get started with those steps by first off backtesting, optimizing, creating a risk management plan, and creating a full trading plan you can follow with RD here. Let me know how it works for you in the comment section below. If you enjoyed this video, please click that like button for me. Go ahead and subscribe if you are new and click the notification bell. Don't forget to get the free spreadsheet by clicking the link in the description. And also don't forget we still have some space available in the TTC FX University. That is going to be the top link in the description. With that, I'm going to end this video and I'll talk to you guys in the next one. See you soon.